A single $100,000 investment could generate nearly $10 million in withdrawals and still keep growing? And what if I told you it didn't happen by avoiding risk? It happened because of how risk was handled. My name's Mike Adams, Adams Financial Concepts, and I want to tell you a story. His name is Ron. And over the last 3 decades, Ron experienced something most investors say they want, but almost no one can actually live through. Because along the way, his account dropped 25% and up, and then 40%, and even 60, it was down even 60% at times. So here's the question I want you to think about as I tell you this story. How do you go through that and still come out massively ahead? And here's where it gets uncomfortable. If I showed you a portfolio that lost 50%, most people would run. And what if I told you that might be the exact reason it wins? And even more important, why do 97% of money managers fail to consistently beat the S&P 500 when a tiny minority quietly compounds wealth over decades? Hold that thought. Ron started with $100,000 in 1990. Actually, to be specific, he opened the account on December 31st, 1990. So saying he started in 1990, he was one day in 1990. And over time, he added some money. He added almost $300,000 along the way. And most of the 300 came in pretty early. And he withdrew along the time. But here's what matters. Here's what really matters. His total withdrawals have been $9,982,899. Think about that. Think about it. That account started with less than 400,000, started with 100,000, 300,000 added, generated over $11 million a gain. And it stayed through the dot-com crash. It stayed through the 2008 Great Recession. It stayed through COVID and multiple brutal downturns. Now think about that. Most investors don't fail because of bad investments. They fail because they can't stay in the chair when things get hard. Ron did. And not because he's different, but because he understood something most people don't. Remember the question? How do you get through 50% downturn and not still win? Because volatility is not the enemy of returns, it's the price of admission. Every great investor, Warren Buffett, Peter Lynch, Philip Fisher, John Templeton, Roe Price, they all went through the same thing. And the difference? They didn't confuse temporary loss with permanent loss. So early in my career, I asked a very simple question. What does it actually take to be great in this business? Not average, not good, but great. And because I have a mathematical background, I wanted to find it in mathematical terms. And I didn't know if I would find that there were hundreds or thousands of investors that did this, or if there was no one. But I set out a very simple kind of criteria. 20% annual returns for 25 years. What that does is it turns $10,000 into $1 million. Sounds simple? It's not. Because almost no one actually does it. Everyone loves to talk about beating the S&P 500, or they love saying it's impossible to do, don't set your sights on it. But here's what they don't tell you. Beating it once is easy. Beating it over a long period of time is extremely rare. Less than 3% of money managers do it. So the real question isn't, did you beat the S&P 500 last year? It's, do you have a repeatable approach that works through full cycles? So let me simplify how we think. And let me talk about how this works. A philosophy that's simple and straightforward, how we think. We don't try to be right all the time. That's impossible. Because we only need to be right a third of the time to break even. Because we look for investments which have twice the upside as downside. They can grow twice or they can drop by 50%. So here's where we look. If you buy 3 stocks, each one at $10 a share, and they have the potential of going to 20 or the risk of going to 5. And just talk about it in simple terms. You buy 1 share of each stock, that's $30 out of pocket, right? So you start with 30, and if 2 of those fail and only 1 works out, you have 2 that go to 5, and you have 1 that works and goes to 20, you break even. You know, it's a matter of stock selection. When I got into this business in the 1980s, I was told in order to make money in the market, you have to be right 66% of the time. Early in my career, I wanted to think, is it really that kind of deal? Do you have to be right 66% of the time? Seemed to me there was a better way to do it, and this is the way. You cannot play Wall Street's game and win. You cannot play Wall Street's game and win. What we do is we have to focus on long-term returns, not this coming quarter, not this year, but where are we headed in the next 4 to 5 years? What do we expect the stock price to be then? And we're not that specific. We're not going to say a stock's going to go from 33 to 67.25, but we get into the ballpark. And you can't play Wall Street's game. I say it again and again and again, because Wall Street has computers who can look at a ton more data than you can. They can process more, they can process it faster, and they're more nimble. So what you have to do is you have to find things that they do not do. And that means you have to be looking at ways to do better. The first part of that is stock selection. So I was a math major undergraduate, got my MBA at Carnegie Mellon, got my undergraduate degree at Oregon State. And so as I thought about this whole process and thought about this strategy, I began to think about, what is the optimum number of stocks to hold in a portfolio? Is it really 300? Is it 900? Is it 2? So I came up with this idea of a game. Came up with a game of having 100 bets, 100 times the bet. Is that a game theory? 100 times the bet. Every time you win twice your bet. Every time you lose your bet. So you have twice the upside as downside. And if you're right 50% of the time, half the time you're right, half the time you're wrong, how does that work out? Well, there's a couple ways to play. Number one, you can bet $1 a time. You bet $1, you start with $100, you bet $1, you win $2, so now you have $102. You bet $1, you lose, because it's 50-50, you lose, you have 101. You work that out, and the expected return is $150. You're going to do okay. You're going to do very okay. But there's another way to play it. Suppose you bet 10% of what you have. Start with $100, you bet $10, and you win, you now have 120. So you bet 10% of the 120, you bet $12, and you lose, you have 108. You continue that whole process, and the expected return is not 150, it's 4,700. You can begin to see where I'm going with this. Suppose you bet 25% instead of 10. Well, let me back up a minute and say one other thing. It doesn't matter the sequence of wins and losses because math's commutative. If you bet $10 and lose, you now have $90. You bet $9, you win, you have 108 because 2 times 9 is 18. 18 added to 90 is 108. Same as if you bet won first and then lost. Same thing. Betting 10% gets you to 4,700 no matter the sequence. But if you bet 25%, the expected return is 36,000. Compare that to 150. 36,000. As it turns out, if you bet 40% each time, the expected return is 4,700. If you bet 51%, you end up losing money. From 100, you go to 36. And of course, if you bet 100% each time, the first time you're out of the game. What this says is the optimum number of stocks to own in a portfolio, if you want to maximize the upside, is just 4 stocks. Just 4 stocks. There were no studies that were done that showed the optimum number of stocks in a portfolio. Actually, there was one done in 1978, but I hadn't seen that when I came up with this idea. But I also thought it's not just a matter of upside. There's the downside. There's the downside to consider. And that led me to studies that were done. And in this case, I found a study that was done by William Sharp when it was at the University of Washington. And the study had been done before by others. But what Sharp showed is there's no statistical difference between owning 300 stocks and owning 8 or 9 stocks. The risk, and by risk I mean volatility, is almost the same here as it is way out here. The risk is owning 4 stocks, you're way up here with volatility. With owning 8 or 10, you're down here. So there's another point. You can really understand when you own 10 to 15 stocks. You can understand the conviction. There have been studies that have been done that show on mutual funds, if you look at just the top 10 holdings in mutual funds, those do better in 80 or 90% of the case than the S&P 500. It's the other 190 stocks or 390 stocks that drag down the return. You know, that's how we build portfolios, built on those 3 principles. Twice the upside is downside, a limited number of stocks in the portfolio, and there's 2 approaches to this. There's don't put all your eggs in one basket, and the other approach is to put all your eggs in one basket and watch the basket. We're part of the latter. We're looking for focus stocks. That's where we are. That's what we do. That's why that's our performance. Look at this. Our clients if you started with 500,000 in 2009, our clients have gotten to 7.5 million. Just think about that. The average financial advisor with all the financial planning and all the asset allocation and doing all that with a focus, they're getting from 500,000 to 1.2 million, which is not a bad return. But comparing that 1.2 to 7.4, where would you rather be? And yes, we have to say there's a lot of volatility there. There is. But there's one other thing. One other thing that doesn't show in the performance numbers, and that's what happens during declines. Because we harvest tax losses. Those losses offset gains, they reduce taxes, and they increase net worth. They don't show up in the performance numbers. So are you, as you look at this portfolio, as you look at your own portfolio, are you measuring what actually matters or just what's easy to see? So let's bring this back to you, because right now you're being told to stay diversified, to avoid volatility, and to chase stability. And yet, what happens when you do that? Most portfolios underperform they're over-diversified, and they're tax inefficient. So you have to decide. This isn't for everyone. You have to decide. Do you want to feel safe or actually financially successful over time? Because here's what I'll tell you. What we do is not for everyone. Because most people can't handle the volatility, they won't stay disciplined, and they abandon a strategy at the worst time. They sell low and buy high. But for the right person, this approach can be life-changing, just like it was for Ron. So here's the next step. If you really want to see how your portfolio stacks up, where you may be losing money without realizing it, where you may be leaving money on the table without knowing it, whether this approach makes sense for you, no pressure, no obligation. I'll show you exactly where you stand. Because the risk you face, the biggest risk you face now, is not the market. It's what's wrong with your strategy and not knowing it. So with that, let me open up for questions. Let me ask what questions you have.
Hey everybody, it's Chris Prouty and I am back. Mike, that was insightful. I've seen you go through these calculations before, but every time I see it, I learn something new. So I'm grateful to see that again. Mike, somebody says, how did Ron stay calm through a 60% drop, for example?
I don't know. We talked during the drops.
Mm-hmm.
I explained what we owned and why I felt it was one of those times which would recover. Let me show you something. On this graph and past performance is no guarantee of future results, but the same stocks we owned here at this very bottom, with the exception of one stock, are the same stocks we owned here. They were also the same stocks that we owned here, except for one stock that is out of the portfolio. And yes, that stock did have a period of time in which it just did not perform and was sold at a loss. We harvest the tax loss, and that offsets some of the gains. The same stocks we owned here, we own here, we owned here, we owned here, with the exception of one stock. What made the stocks worth this value instead of this value or this value? Computers and computer trading and short-term Wall Street's focus. So how did Ron stay focused as we went through this period of time? I told him, you're a smart guy. You know that the stock, if it was worth this amount here, and it's going to be worth this amount here. In the best estimate. And in fact, it has been. Anyway, I hope that answers the question.
Thank you, Mike. In the chat, everyone, I've just put a couple of links. First, if you'd like to see the replay of this broadcast, you can do so by going to our YouTube channel, which I've included in the link, and that handle is About Money Radio. You can see the rebroadcast of this episode, plus all of our previous episodes. As many of you know, Mike and I are here every Thursday with these live, and then we put them on the YouTube channel the following week. And then Mike has also released his latest ebook called The Commodity Trap, which is captivating, and people from the internet everywhere around the world have been requesting that book. And if you'd like to get access to that book, you can send him an email at mike@adamsfinancialconcepts.com. That link is in the chat as well. And you are welcome to request that ebook and chat with Mike. I know that he reads and responds to every single email. Mike, another question. Somebody says, could you go over how you pick which stocks to keep and which you elect to cut?
So there's two types of stocks that I really like. And my portfolios are not completely limited to that, but over the long term, that accounts for 95 or 90% of the stocks in the portfolio. The one is where the stock market cap, where you take the price of the stock times the number of shares, where that market cap is less than the actual cash the company has on the books. And they have a positive cash flow. In my entire 40 years, that's only happened 2 times. Only 2 stocks have I found it. One was a company that developed the digital phone system, where when you call in to somebody, if you want to speak to Mike, dial 1. If you want to speak to Chris, dial 2. If you want to speak to Joe, dial 3. They developed that system and they had all sorts of problems in the beginning. The stock came public and immediately traded down 70 or 80%. They had a lot of cash. They had positive cash flow. They were working through their problems. The stock actually came public at 10 and was trading at 2 3/4, and they had $3.50 a share in cash. I was on the conference call and I asked the question, why not just pay a cash dividend? Within 2 weeks, the stock was back above 10. But that's my, if I could have 10 stocks like that, I would put 10 stocks. But in my entire 40-year career, there've only been 2. And they tend to be very short-lived. The second type is a stock that has 4 characteristics. Number 1, they're a company that has a squeaky clean balance sheet. You grow your revenues and your earnings through one of 3 ways. You earn it, you borrow money to finance growth, or you sell capital stock. I'm looking for those companies that earn it. That means that they have squeaky clean balance sheet. They don't owe any long-term debt. The second thing I'm looking for is a company that has a franchise on their market. They dominate their market. They have pricing power. Think about it. If we're going into stagflation, having pricing power is key to what you need to do. Being able to raise your price as your costs go up. So that's the second factor I look for. And it works not just during stagflation or in regular times, inflationary times. It works during regular time. The third factor I look for is I look for a company whose founders and owners and managers have a significant ownership. I like to see 10 or 15 or 20% ownership by the owners of the company, because that means they have a vested interest in seeing the stock price go up. And especially true if that's their net worth. They have a significant vested interest in seeing that happen. So they're going to try to push the stock price up. If somebody owns 1/100% of a company and they probably already have a diversified portfolio, they don't really have the same incentive. The fourth factor is a stock at a company that's underfollowed by Wall Street. If you have 90 analysts following a stock, there's not very much information that's not known. Take the average, it's going to be the average. I'm looking in the beginning, 30 years ago, you could find stocks like that were underfollowed and had maybe 1 or 2 analysts. Now it's more like 7 or 8, but even at that, it's underfollowed by Wall Street. Those are the 4 criteria. And having those 4 criteria does not mean it always works. Sometimes having those things go on means that the stock never makes it. So when a stock drops, as Peter Lynch said, when a stock drops 25%, if you can't convince yourself you're a buyer and not a seller, you'll never have better than mediocre results. So seeing a drop is never a concern. Seeing a couple drops, seeing a thing flat, it raises the question. So the question comes back, where do I think this stock's going to be in 4 or 5 years? And if I have to say, it's beginning to look like they're losing their focus, if they're not doing what they should be doing, then I sell. Absolutely. if I can see the stock price 4 or 5 years from now at where I think it should be and where I initially thought it was going to be, then I hang on to it. And if it drops, I buy some more. That's my stock selection criteria. Not very
Thank you for that,
complicated.
Mike. I'm going to answer a question that's come in, and somebody says, how do I schedule a conversation with you? And I'm just putting into the chat your email address again. You can just send Mike an email to schedule a conversation. Mike, the next question, can I do, this is, I'm going to read it exactly as they wrote it. Can I do this if I'm already retired?
Sure, absolutely. And if we're going into a period of stagflation, you better be doing it if you're retired. Stagflation destroyed the market, destroyed the stock market, destroyed bond market, destroyed most commodities, and will probably destroy real estate investments as well. It's going to be a stock picker's market because no matter what happens with the market, there's always going to be stocks that do well. So if you're retired, I mean, I've done other programs and talked about the changes in prices. If you're retired, are you going to continue to be able to buy eggs at $30 a dozen and bread at $25 a loaf and gasoline at $20 a gallon? That's what stagflation does. And we see a lot of signs of stagflation happening because in stagflation, you not only have inflation going on, but you have a recession. And think about this. There are people forecasting with AI, unemployment could reach 20%. It doesn't have to reach 20% to put us into a recession. It doesn't have to reach 10% to put us into a recession. Because those same people that are out of a job are not buying. They're not consumers. They are just getting by. So anyway, just thoughts, if you're retired, you very definitely need to have something that's going to continue to grow and furnish a greater steady stream of cash, steady stream of income that's going to be increasing through the state of inflation, a stagflation.
Mike, those are all the questions that I have queued up, but I have a question. Could you share with us what you're going to be talking about next week?
Well, as I thought about this, I thought about the story of another person who's asked me not to use his name. Ron was Ron's name. This is a person that asked me not to use his name. His story is he invested with Peter Lynch's Magellan Fund and lost money. Peter Lynch averaged 29% per year for 13 years or 17 years. And this is a person who lost money investing with the Magellan Fund. He is now a client and he is making money. But I thought it would be an interesting contrast. How do you lose money from someone who's making so much money? That's next week. That's the story.
And Mike, with that, I don't have any other questions queued up. So I want to thank everyone for their time and for being here today. Some great questions came in. Mike, as always, informative and insightful. I'll hand it over to you for the final word.
I wish you all a very good week. Fun time in the market. It's got its ups and downs. So I will be back next Thursday to talk about an interesting client who actually is making money now, but lost money with Magellan Fund. To me, almost inconceivable. But anyway, he did. That's next week. Join me then. And until then, have a great time and make money in the market.